IRA and 401k average retirement savings from Fidelity, from Vanguard, and from Charles Schwab. That's what we're going to look at today on the live stream. And the reason I want to look at Fidelity, Vanguard, Charles Schwab, all of these custodians handle 401ks. They might handle your IRA, and they handle your taxable brokerage accounts. And all of these custodians have given different information when it comes to the average and the median savings for retirement. So I think it's really, really important that we look at all three. We look at it in the context of where we're at today, and then we get a good idea for ourselves how we can move forward. Now, thank you so much for joining the live stream. My name is Drew Blackston. I'm a certified retirement counselor, investment advisor representative, and I am your virtual financial advisor. I'm going to help you get to retirement. We're going to work to get you through retirement, and we're going to protect your ability to stay in retirement. The S&P 500 is down 15% this year as of this recording. So naturally, when you think about the S&P 500 being down, naturally you would think that retirement savings are down as well. So the amount of money in your 401k, the amount of money in your IRA, your Roth IRA, your 403b is going to be less because the stock market is down 15%. And if you look at a 60-40 portfolio of equity and bond, the traditional 60-40 market exposure, that portfolio has had the worst year that it has ever had. Why is that? Well, stocks are down because the S&P 500, the Dow Jones, and the NASDAQ are down about 15 to 20% year to date. But the bond market, the fixed income market, which is supposed to be your conservative hedge against risk, is also down this year. You're looking at 10, 15, 20% losses in the bond market, depending on how you are invested. And the reason for that is as interest rates go up, bond values or the value of your bond goes down. So we've seen equities go down, and we've seen fixed income go down. We've seen stocks go down, mutual funds, ETFs lose money, as well as traditional bonds. So you look at that and you would say, hey, because of that, retirement savings is probably down as well. Now, one of the interesting facts that Fidelity pointed out to us, they say that 401k retirement contributions have stayed at 13.8%. Let me show you this. So this is Fidelity. This is their quarter three. Okay, so the third quarter of 2022, their quarter three average retirement savings rate. And look what they say. A total savings rate for the third quarter, which reflects a combination of employer and employee 401k contributions, remains steady at 13.8% compared to 13.9% in quarter two. So we really just went down like 0.01% from 401k contributions. That means the employee and the employer putting money into the 401k, traditional and Roth, and 14% in quarter one. So remember, quarter one, the stock market started out really high, and then we just crashed basically going into June and July, and we've recovered some of that so far. So we saw a little bit of a decrease, 0.2% decrease from 14 to 13.8, which is just below Fidelity's suggested savings rate of 15%. Remember, if you're saving for retirement, you want to be saving at least 10 to 15% of your gross income for retirement. 10 to 15% of your gross income. Gross means before taxes. So if you make $100,000 a year, you want to save $10,000 to $15,000 before taxes in some sort of retirement savings account. Now, it doesn't have to be a 401k. It could be a 401k and an IRA, a 401k and a Roth IRA, as long as your income falls below the thresholds for an IRA and a Roth IRA. It could be a 401k and a taxable brokerage account. I talk a lot about this on this channel. If you're putting money into your 401k and you're getting your match and you're putting all that you can in and you want to invest more, you're putting the max in and you want to put in more, put it into a taxable brokerage account. If your income does not allow you to put money into an IRA or a Roth IRA, put it into a taxable brokerage account. Just open an account at Fidelity, Vanguard, TD Ameritrade, Charles Schwab in your name and act like it's a retirement account. Put money into it And the beauty of a taxable brokerage account, I call it a freedom fund. It gives you the freedom to do whatever you want. If you want to invest, or if you want to retire at 55, you can invest in that taxable brokerage account. And then at 55, if you want to retire and you've got the ability to do it, you can pull money out of that and live to 59 and a half, where you can start using your retirement funds. So make sure you're putting in 10 to 15% and go above and beyond. So in fact, the majority of workers, 86%, kept their savings account contributions unchanged. 86% of workers continue to contribute even through the mass volatility, the chaos that we've had this year. 7.8% actually increased their contribution rate. Men continued to save at higher rates than women, 14.5 versus 13.5. And so then we can go through this. So what this is showing us is people are continuing to contribute into their 401ks, into their retirement accounts, even through some of the volatility that we've had here in the market. Now, what I get when I read all this, because I get Barron's, I get the Wall Street Journal, I read things online, I get confused. And maybe you're confused as well, because I read something like that from Fidelity, and it says that 86% of workers did not change their contribution rate, did not change it. They continued to invest. And I look at it and I go, well, when I read what Charles Schwab said, let me show you this. Oh, that's the wrong one. Let me show you. So Charles Schwab put out something recently, and this is what confuses me. Let me show you. This is from Charles Schwab, and this says, according to Schwab's annual nationwide survey of 401k plan participants, 79% of workers are changing their saving and spending habits because of inflation, while 44% have altered their 401k investments. So it says workers are cutting the number of purchases they make, right? So because of inflation, they're changing their spending. They're buying cheaper products. They're paying off debt slower. Now, this is according to Schwab's study, which you could just Google and find anywhere. But what is confusing to me about this, 79% of those surveyed workers under Schwab, the Schwab 401k system, 79% of workers are changing their saving and spending habits because of inflation, which is understandable, right? I shop at Walmart and Aldi, and we have a store called Publix here in Florida in the Southeast. We've changed what we buy because of inflation. I'm not going to buy a $5 case of milk. I can buy a $3 case of milk. We've changed the diapers that we're purchasing because of inflation. I don't need to buy Huggies or Pampers if my baby boy fits good in Target diapers. Hey, listen, I can get 180 for $30, or I can spend $30 on Huggies and get 12, right? We've changed. But what confuses me about this is it says that 44% of surveyed workers have altered their 401k investments. I actually did a video recently that talked about people stopping or changing, lowering their 401k contribution because of the market, the volatility, and I can't tell you how many people I talk to, and they're like, "Hey, Drew, I don't want to invest in my 401k because it makes no sense. Like, why do I want to invest in my 401k when it's going down?" And that's the worst decision. That's the worst thing that you can do, especially in a down market. When the market is lower, continue to invest. So what's strange to me is that Schwab is saying 44% of people have altered their 401k investments. 44% of workers have altered their 401k investments. And then if you look at Schwab, or if you look at the Fidelity survey, so let's go to the Fidelity survey. Fidelity says that 86% of workers, in fact, the majority of workers, 86% with Fidelity, have kept their savings account contributions unchanged. I don't know. I'm confused. I mean, this is weird, right? Because Charles Schwab, who's our custodian, we manage assets for clients. We use Charles Schwab and TD Ameritrade. They're saying 44% of participants have lowered or stopped their contributions. Fidelity is saying that 86% of workers have continued contributing. I don't know who's right. And like, I don't have the answers. I wish I had all the answers. And I know that when I put out a video, maybe you have the answers. What do you think? Leave it in the comment section. Are you changing your contribution? Are you continuing your contribution? Have you increased your contribution? Have you increased your retirement savings rate because of the market? Have you changed the way that you invest because of market volatility or inflation or anything? Leave that in the comments. Would love to see what you have to say. So let's look at the numbers. Let's look at Fidelity first. So let's look at what Fidelity says. John Gill says different statistical base. Great answer. But still, how can so many different custodians put out so much different information? Because really, if you think about it, John, the guy working at a 401k in an accounting firm in Ohio that has Charles Schwab is not much different than the guy working in an accounting firm in Nebraska that has Fidelity as his custodian, right? And so again, it's just, it looks at the, I don't know. And I think you might be right. Different statistics. Who are they surveying in this sense? But let's look at the numbers. Let's look at the numbers. All right. So here's what Fidelity says. So the average retirement account balances, let's zoom in a little bit on this for you. Now keep in mind, this is the averages. So don't be putting in the comment section median. I don't have the median for Fidelity. All I got is the average. The average is going to be skewed a little bit because you got the highers and you got the lowers. And then we're going to get to the median with Vanguard here in just a minute. But the averages are going to be skewed. The median's right in the middle. That's really where we want to look. So Q3 of 2022, the average IRA with Fidelity was at $101,000. That's Q3. Q2, 110, and Q3 of 2021, 135. So you can see from 2021 to 2022, we were down about $34,000. So let's do some quick math. 135,700. Subtract that from 101,900. That's 33,800. Divide that into 101,900. That means that 401 or IRA balances, average balances from Q3 21 to Q3 2022 are down about 33.17%. 33%. Now keep in mind, as of today, the S&P 500 is up down 15% year to date. So Q3 ended when? January, February, March, that's Q1. April, May, June, that's Q2. July, August, September. So we're talking the end of September. So it doesn't count in October where the S&P had a really good month. I think it was the best October that we've had since like November of 76 or something. And then we also had a pretty good start to November. So we've got about a 33% decrease in Q3 from Q3 21. So year over year. Now 401ks, average 401k balance, 97,200 Q3 2022. The average of Q3 in 2021 was 126. Now here's what concerns me. So this is the average retirement account balance for Fidelity. Okay. Averages are skewed because you have a lot at the top and you got a lot at the bottom. So when they average those out, you average some zeros at the bottom and some 10 millions at the top, it really skews those average numbers. But if you're like 40 to 50, 50 to 60, and your 401k is only $98,000, that's not going to be enough to retire. And so we've really got to start looking at ways that we can continue to grow our 401k, continue to grow our IRA, even during market volatility and even during inflation. That's why it's so very important. We're going to talk about that in this video, how to continue growing your 401k and IRA. I'm going to get into some investment side of things, which I don't get into very often, but I'm going to show you some investment side of things, especially my own investing, how I do that. But you really want to continue to, because remember, 86% of workers, according to Fidelity, are continuing to contribute to their retirement savings rate at the same level. Now, Charles Schwab is saying a different thing, but what you're looking at here, when the average with the 401k, we've got to get these numbers up so that we can retire before. The average retirement age right now is 66. We want to retire before then. Okay. Average 403b, 87,400, Q3 2021, year over year, 110,800. Now, John Gill says this: I increased my savings and changed my asset allocation to 100% stocks. That's great. That's awesome. That's great that you did that, John. Continue to do that. So let's look at some of the other information from Fidelity survey, which I thought was really interesting. So we're going to look at Fidelity now, and then we're going to go to Vanguard next. And we've looked at Vanguard a few times on this live stream. I really like the Vanguard survey because it shows the average, it shows the median. It's going to break it down by income and age. So we're going to look at Vanguard here in just a second. But here's some information from Fidelity, which I thought was really, really interesting. Despite this, all the stuff going on, Gen Z 401k savers actually increased their balances slightly this quarter. Gen Z savers who are heavily invested in target date funds, the average account balance actually increased 1.2% over last quarter. And as of quarter three, 85% of Gen Z savers have all of their 401k savings in target date funds. Target date funds continue to increase in popularity with 93.2% of plan adoption in quarter three. So you're starting to see target date funds become more popular, and they're becoming the predominant mutual fund in 401ks, and Gen Zers are just automatically going into that because, hey, that's an easy way to invest. Now, is that the right way to invest? I don't know. We got a video coming out on whether target date funds are the best way for you to invest. So keep your eye out for that. Now, the number of IRA accounts continue to increase, especially among Gen Z and millennials. So we're starting to see millennials and Gen Zers open up IRA accounts. Now, keep in mind, Gen Z and millennials, they might not have the ability to have a 401k at work. A lot of them are among what they call the gig workers, which are people that are working for maybe a DoorDash or doing work that is outside of the traditional go to a job, put on a suit, get a 401k. That's the Gen Z and millennials. A lot of them make money online or they work from home, and you're starting to see them increase their IRAs, which is really good. So the total number of Fidelity IRA accounts continues to climb, reaching 13.2 million, an increase of 11.2%. And the younger generations continue to lead the way, with Gen Z increasing 83%. So you're starting to see younger investors start to invest in the market. Don't believe headlines when people say, younger people don't believe in the stock market. Younger people saw their parents in 2008 and they don't trust the stock market. Younger people saw, whatever in the 2000s and they don't believe in the stock market. They do. Investing in the stock market, and I've said this over and over again, the stock market is the greatest wealth creator that the world has ever seen. Now, the stock market's been around in some form or fashion since ancient times, but the United States stock market is the greatest wealth creator the entire world has ever seen. Actually, I'm reading a book right now about Dwight D. Eisenhower, and I'm in the section where he is the head of the United States military operation, pretty much the head of the Allies military against the Axis. And a funny quote was Hitler and Stalin both thought the Americans were really good at making money, but terrible at fighting. And that's what they thought going into the war, that we were going to be terrible at fighting, but really good at making money. And the reason for that is because we have a great way to do that within the stock market and the way business works. Capitalism is still the greatest way to grow wealth here in America. Total 401k rates continue to hold strong. We talked about this. The total savings rate for the third quarter remained fairly steady at 13.8%, meaning contributions remained steady at Fidelity. All right. So let's look at, we've looked at Fidelity. Here are the numbers. Take a screenshot, take a picture. Let's look at Vanguard, because I've shown Vanguard, and I'm going to keep Fidelity up there because I want to kind of compare the two. Here we go. All right. Get Vanguard up here. Here we go. So this is the Vanguard, and what you've got is you've got the average and the median, and this is all participants here, and we're going to do it by income and age. That's what we're going to look at today. Let's go to age first. So make sure I got this right. Average, yeah, here we go. Average and median. So 25 years old or less than 25 years old, the average money saved in retirement accounts is $6,200. The median is $1,700. And this is the reason I like the median, because the median is right in the middle, right? The average is really skewed to the high side and to the low side, but the median is right in the middle. And the median really tells us really where America's at. So under 25, $1,700 is the median save for retirement. Now keep in mind, under 25, I think when I was under 25, let's see, I was working at a golf course at 21. I think I had $500 saved for like mustard and beer, right? That's really where we were at 21, 22. But 25 to 34, the average savings for retirement is $37,211. The median is $14,068. Age 35 to 44, $97,020. Look at this. $97,020, ages 35 to 44 is the average save for retirement. The median is $36,117. Now, what this shows us if we go back to Fidelity, okay, let's go back to Fidelity real quick. Let me show you what Fidelity, we just said between 35 and 44, the average is 97,020. Fidelity, the average 401k balance, okay, Q3 is 97,200. So what Vanguard is showing us by breaking it down by age is saying between the ages of 35 and 44, okay, the average retirement savings with Vanguard is 97,020, the average. For the 401k balance for Fidelity is 97,200. So what we can assume from this is that the majority of workers are going to be your middle age, 35 to 50, and that's where you're seeing this number come up here. So as a financial advisor, I look at this and I say, okay, 35 years old with $97,000 saved, 40 years old with $97,000 saved. We've got something to work with because we got time on our side, right? We have compound interest and time on our side to get to retirement. All right. So let's go back to Vanguard real quick. Let me show you. Vanguard. There we go. All right. Here we go. So 35 to 44, 97,020. The median's 36,117. 45 to 54, 179,200 is the average saved. 61,000 is the median. 55 to 64, 256, 244 is the average save for retirement, and 89,716 is the median. 65 plus 279 is the average. 87,000 is the median. 65 plus, I'm not really that worried about. People, the average retirement age today is 66 years old. So you're probably not going to be saving a lot of money plus 65 in the sense of for retirement, right? You're not going to be in a 401k, a 403b, that kind of thing. Okay, so we've got Fidelity and we've got Vanguard. And we've got two different figures. We've got the average savings based on averages and medians with Vanguard, which show us that, hey, between ages 45 and 54, we've only got $61,000 saved. That's kind of that, you know, I always equate retirement to flying an airplane. And so if you've ever, we live in Tampa, our firm is in Tampa, Pearl Wealth Group, that's our website. But if you ever go and you fly into Tampa, if you're coming from the Northeast or the West, you usually will fly over the Gulf of Mexico, okay, as you head into Tampa Bay to land at the airport. And it's a beautiful place to land because if you look out your window, you can see all the houses on the water. But one of the things that really kind of creeps up, especially in the summertime, is we get a lot of storms. And so if you're coming into land, there might be an unexpected storm. Well, if you're 45 to 54, you're probably at like Texas, right? Tampa's where you want to land. You're in Texas. You got like an hour away. And we're kind of getting into that landing strip of where we've really got to start preparing for retirement. And if we've only got $61,000 saved for retirement at 45, we've really got to start batting down the hatches to get more saved for retirement. And I'm not just going to use, let me just not use Vanguard, because people always go, well, you're using Vanguard. Look here, let me show you Fidelity. Fidelity. If we only have saved $100,000 in our IRA, if we only have $97,000 saved in our 401k, if we only have $87,000 saved within our 403b, and we're between the ages of 45, 54, we're 50, we need to really batten down the hatches and start saving more for retirement. Because if you don't, and you want to retire earlier, you can't. You're going to have to wait to Social Security age. You're going to have to wait until you have a pension. You're going to have to wait till something. And so we've really got to start looking at ways that we can save. Now, this year, it's a great year to do that. The market is down 15%. As of this recording, the market is down 15% year to date. And with the market being down, if the market's down 15% year to date, this is a great time to be investing at these low rates. If you've got a 401k and you're contributing to your 401k, if you have an IRA and you're contributing to your IRA and you're not maxing it out, and you have extra cash left over, continue to invest in your 401k, continue to invest in your IRA, and possibly increase that contribution. Think about it. The S&P 500 is down 15%. The total market, okay? The S&P is down. Take some of that excess cash and put it into the market. Invest at these lower levels. But Drew, you don't understand. We've got inflation and the market's going to crash. And I was reading this website the other day that said that this was going to happen and the market was going to go down, the dollar was going to be replaced. I can't predict Armageddon. Like, I don't know. Like, I can't predict like a 50% market. But if you leave the money in the bank in cash, if you've got excess cash, you're going to lose. You're going to lose. Inflation's going to kill it. Take that money and invest. Listen, all I can do is look at history. Okay. Now, I'm a big history buff. I love to read. I'm reading Eisenhower's book right now. I've read from Revolutionary War, the Civil War, Greek, I've read it all. Not all of it. I want to read more. If you got any good books about history you think I should read, put them in the comment section. But if you look at history, you look at the United States and you look at the stock market, think about what we've been through as a country and where the market is today. And just start in 1900. Just think about 1900. We went through a world war, World War I. We went through a Great Depression. Okay. We went through World War II. We went through presidents assassinated, attempted assassinations on presidents. We went through an oil embargo. We went through high inflation. We've been through a tech bubble. We've been through a real estate crash. And we've been through a pandemic. And we're going through high inflation now. And we've been through a lot of other stuff in between. Terrorist attacks, Lehman Brothers going bankrupt, FTX going bankrupt. We've gone through all kinds of different economic situations. And the market today is higher than it was 10, 15, 20, 30, 40, 50 years ago. So the stock market is still the greatest driver of wealth here in America. And with the stock market being down 15% year to date at the time of this recording, it is a great time for you to invest low, buy low, and sell high. Because remember, if our 401ks are at 100 or at 97,200, if our IRAs are at 101,900, and our 403bs are 87,400, and that's the average, we've got a lot of work to do. Because if you've watched this channel at all, you know, when I'm doing a video called "Can I Retire At?", it takes a couple different things to retire at certain ages. It either takes a large amount of money if you want to retire early, okay? Or it requires you to have less expenses, less debt if you want to retire early, or even retire at 60 or 62. Or it requires you to make changes like working longer, working part-time. So if you are younger today, when I mean younger, I mean early 50s, 40s, 30s, and you have the ability to increase your contributions, or you're already maxing out your 401ks or maxing out your IRAs, take that excess capital or that cash flow that you got and put that into a taxable brokerage account. Put that somewhere to invest. Don't let that money just sit in your account. One of the things I tell all my younger people, especially if you're in your 30s or 40s, is to live on a budget. And I know budget sounds like Dave Ramsey, but there's a reason that Dave Ramsey does so well. It's because he lives on a budget, and the people that he helps live on a budget. And I'm not here to tell you how to spend your money. I'm not the financial advisor that's going to tell you not to go to Starbucks, or because I like Starbucks. I think they've got good coffee. I'm not going to tell you not to do this, that, or the other, but just make sure that you make the adjustments for you. Don't live over your means. If you like Starbucks, I like Starbucks. We just don't do other things. I go to Aldi for my groceries. Okay. So I go to Starbucks for my coffee. And funny, where I live in Tampa, they're right next to each other, which is great. I go get some coffee and then I go get my groceries at Aldi. So continue to put money into your 401k and IRA. Continue to contribute, continue to invest, and invest based on your age and risk tolerance. So Alexander Bailey says this: for me, VOO and VTI are my long-term investments. VOO is the S&P 500. VTI is the total market. That's great, Alexander. That's wonderful. Depending on your age, Alexander, how old are you? Because you're doing a great thing. You want to continue to do that. And I never can say the dear guy says this. I think it's Kevin. Always review the 10-year average of target date fund compared to other funds available. I don't have any target date funds. We just talked about that. Fidelity said that target date funds are becoming the most popular fund within 401ks. I've got a video coming out very soon about target date funds and why they actually might not be the best investment for you, especially if you understand investing. And you don't have to be an investing genius in order to adjust your 401k for better returns. Watch the video. I don't know when it's coming out. I got to check that out and figure that out. I'll put that out there, but it's coming out very, very soon. I'll give you a little piece. I'll give you a sneak peek. Okay. I'm going to give you a little bit of pumpkin pie before your turkey. My grandfather always used to say, eat dessert first so you don't die. Or if you die during dinner, you had dessert, right? Okay. So let me show you this real quick. And this is what Kevin was talking about. Target date funds. All right, so this is a target date fund. This is the Fidelity Freedom 2040 fund. And this is what I'm going to talk about in an upcoming video. Now, this is a fund that says you're essentially thinking about retiring in the year 2040, okay? 2040. So what's today? 2022, as of this recording, what's that? 3240. So we got 18 years. So 18 years until retirement. These are becoming the most popular. But here's what I want to show you. If you've got 18 years before retirement, you're probably trying to grow your money as much as possible. So let's say you're going to retire at 60. So let's take 60, let's subtract 18, that's 42. So let's say that you're 42 years old and you're investing in the 2040 Fidelity Freedom Target Date Fund. Well, at 42, if you called me, my advice would be the same that Alexander just gave it to all of us. VOO, VTI, maybe the Russell, maybe some NASDAQ. Just grow your money as much as possible. No fixed income exposure unless you want a little bit. Okay, I've got some fixed income exposure just because I think at this point in time, it makes sense to have some bond exposure because interest rates are going up. And you can get some, if I'm a long-term investor. But for the most part, VOO and VTI. So the 2040 Fidelity Fund, you're 42 years old, you're going to retire at 60. How this fund is invested is based on the risk tolerance of somebody that's going to retire in 2040. And so the first thing I always look at when I'm looking at a mutual fund is the expenses. I want to know how much does this thing cost? And you can do that with an expense ratio, gross and net. So for this fund, the 2040 fund, the expense ratio is 0.75. 0.75. John Gill says international stocks should also be included. John, we're going to argue about that for the longest time. Okay, we're going to have a side discussion about that. VXUS, that's what I have in my portfolio. That's the international stock market X the US. So John, I'll give you a high five on that one, but we're going to talk about that. So expense ratio for this Fidelity fund is 0.75. That means that this fund charges 0.75 internally. Okay, that's just the expense ratio. I'm not talking about the turnover ratio, just the expense ratio. Turnover ratio is 29%, which is low, but there's still some charges with that. 0.75 expense ratio. If you go to a financial advisor like me and you go to somebody who does asset management, they're usually going to charge you, let's say 1%. Now we charge our clients anywhere between 0.5% and 0.75 to manage their assets, to do tax planning, to do investment management, to do estate planning, to do the financial EKG, to do their income plan, to do everything, Social Security. So that's what we charge, our quarterly reviews to make sure the clients have a place they can call. Okay, so that's what we charge. This mutual fund is charging that just to invest this 2040 fund. So if a mutual fund, and I don't want to get too deep into this because I'm getting on a rabbit trail, but if a mutual fund is charging 0.75, okay, it better be delivering what it's out to deliver. So if you're 42, this is the 2040 fund, right? So this is the 2040 fund. That means we're going to retire at 60. You take 40, or you take 60 minus 18, that's 42. So we're 42. What are we trying to do here? Well, if we look at the S&P 500, okay, let's just look at the S&P 500. Year to date, as of 10/31, the Fidelity Freedom Fund is down 21.5%. The S&P 500 down 17.7. Okay, so the S&P, which is, the stock market, is down 17%. This Fidelity Freedom Fund is down 21.5. Over 1 year, the Fidelity Freedom Fund, year over year, okay, September to September, down 21.45. S&P down 14.61. Ooh, 3 years. So over the last 3 years, average annual total returns, 3 years, September 3 years ago to September now. This Fidelity Freedom Fund, 42 years old, maximum growth, retiring at 60. We made 4.79%. The S&P's made 10. Just a little bit of a difference. 10 years, 7.89 and 12.79, and life 4.31 and 6.42. When life is when the inception, so from the year 2000. So keep in mind, if you got into this in 2000, you had the tech bubble, you had the real estate crash. S&P still made 6.42 and you made 4.31. So my question is, when target date funds, okay, is that a good investment? We're going to talk about that on a video upcoming. Target date funds equal not so great. Maybe not. Maybe not. And so we're going to look at that in just a little bit. That was my rabbit trail for this video. Alexander says this: I'm 63 years old. My advice is to start as early as possible and try to set a goal to retire as soon as possible. Feel like I should have retired at 62. You burn out as you get older. That's true. You do burn out as you get older. I've got a lot of clients who are just like throwing up their hands like, I'm done. I'm ready to just be done. And the reason you want to have money saved for retirement, I'm sorry, I get excited. It's Thanksgiving week. I'm getting turkey in a few days. But the reason that you want to continue to save for retirement is because you're going to get to 60. You might be 40 now, but you will be 60 soon. And when I say soon, I mean like that, right? Our life is like a vapor. That's what the Bible says. And it's so true. I'm 37 years old. I'll be 37 in a month. So I'm 36 years old. I got 3 kids. You can see their artwork here. Woo! They do a really good job. I got 3 kids, 2 dogs, a house, life insurance, and I run a business. 16 years ago, I was 20 years old. I was playing college baseball. I was going to be a major leaguer. Not really. I was never good enough to be a major leaguer, but I was playing college baseball, and it's gone by fast. It has gone by so fast. And so you want to save for retirement. An awesome decade last night. 40 music is going to be biased. John. Okay, this is target date funds. John says the problem with your comparison is the S&P 500 had an awesome decade last decade with like 14%. Yeah, 15.5% gains. You're right. Using that comparison, that anything is going to be biased. Not necessarily. Think about for the life of that fund. I showed you that. That fund had averaged 4%, something like that. S&P was at 6%. I'll still take 2% gain without paying a 0.75% fee. So we want to continue to save for retirement. Remember, it's so important. I'm going to get into what we need to do saving for retirement. Here's the reason why you want to save for retirement. Let's look at this. I want to show Fidelity too. This is Vanguard, okay? 35 to 44, the average save for retirement is $97,000. 36 is the median. 45 to 54, 180 is the average save for retirement. 61 is the median. If you're in this 45 to 54% range, and you got $61,000 saved, you're probably going to have to work to the average retirement age, which is 66 years old. 55 to 64, the average is 256. The median's 89,000. I would still say 256,000. If you're 55, it's still not enough to retire. So if you're wanting to retire early, we've really got to kick it in gear. Make sure you're investing based on your age and your risk tolerance, okay? One of the things that we talk about here a lot is making sure that you're investing based on your risk tolerance. Let's look at Fast Eddie has a question. Let me stop this. This is a good question. Fast Eddie, what is better? 15% all in a 401k, 10% a 401k and 5% a Roth, or 5% a 401k, 5% a Roth, and 5% a brokerage account? I'm assuming your 401k 5% match, and that is somebody who is 24. Okay, so I mean, I would look at it like this, Fast Eddie. I mean, if you have here's a great way. This is a great segue into what we're talking about. If you work at a job that offers a 401k, a 403b, a TSP, a 403b, 457, anything that has a match, a simple IRA, a SEP, anything, if you work at a company that offers you a match on anything that you do, make sure that you contribute to your 401k up until your match, okay? The 401k is going to offer you the ability to put money in either pre-tax or post-tax. Most 401ks today, you have a traditional side, which is pre-tax, and you have a Roth side, which is post-tax, meaning you pay taxes on your income, but you put it in the Roth. Now, the contributions are going to go in the traditional side, but your contribution will go in the Roth. If you work at a business that offers a 401k and you have the option to do the traditional or the Roth, my suggestion would be to just contribute to the 401k at your job. That's going to be easiest. It's going to have the highest contribution limits. You're going to be able to put a lot of money into that, If you're maxing out your 401k on the traditional or Roth side, if you're maxing those out, then your income limit is probably going to be over the income limit to put in a Roth IRA or an IRA. And so then you want to think about putting money into a taxable brokerage account. So that would be outside. But if you have a 401k, a 403b at work, and you have the ability to go on a Roth side or a 401k side, I would say continue to contribute to that as much as you possibly can, especially if it has a Roth side. So if you're younger, really think about putting money into the Roth 401k, because that is going to give you the biggest bang for your buck. Now, keep in mind, make sure you talk to your CPA, your tax accountant, your investment advisor, or call me, because there are some instances based on your income where it might make sense to put money into the traditional side of the 401k, get the tax break, because at retirement, the thought would be essentially you'd be in a lower tax bracket when you pull that money out, or we'd be doing Roth conversions when you decide to retire. So there's different aspects to it. But Fast Eddie, here was the question: what's better, 15% on 401k all in, or 10% of 401k, 5% of Roth, 5% taxable brokerage? 401k, if you have it at the job, the best thing to do is to put all the money in the 401k if you're offered the Roth side. Now, if you do not have a 401k at work, if you are not offered a 401k at work, make sure you have your money going into an IRA or a Roth IRA, depending on your taxes. Again, it's not just a simple, hey, put money into this and you're going to be all good. If you're younger, 20s, 30s, Roth IRA. But if your income is above $100,000 a year, married or single, you really want to be talking to your CPA, your tax accountant, a financial advisor, or your investment advisor about which is the best route based on taxes. Okay. So I hope that helps. Pay taxes today so you do not have to pay taxes in retirement. That's what Kevin says to Fast. It's true. Pay taxes today. Try to pay as much today, because we know taxes are going up. Currently, we're under the Trump tax return. I don't know if I can say Trump out loud. Most people throw something at you. But the Trump tax return or the tax return for the Trump tax code is a very good tax code right now to invest in Roth IRAs and to do Roth conversions. Okay. In 2025, it's going to revert back to the Obama era tax code, which is not terrible. It's the Obama-Boehner tax code. It's not a terrible tax code. Again, that one I would still, encourage Roth and Roth conversions. Depending on what happens in Congress over the next few years, and depending on what happens in 2025 or 2024, we'll have a better idea with what taxes should be going in the future. John Gill says this: know your choice should be based on which you pay the least amount of taxes, not when you pay your taxes. The goal of your choice retirement accounts is to pay the least amount of taxes. That is very true. And Alexander says this: no debt in retirement is crucial. I love this. Does anybody else have any advice? Anybody have any advice for retirement? So we're going to talk about how to continue growing your 401k and your IRA in retirement. If you've been doing this for a while, give us some advice. Would love this. Would love to hear what you have to say. Kevin says, just follow John on LinkedIn. I am on LinkedIn, at Drew Blackston on LinkedIn. Come out, connect with me, follow me. Would love to talk to you. So here, let's talk about how to continue growing your 401k and IRA. And as we do this, whatever you're doing, if you got advice for people who are saving for retirement, leave it in the comments section. So let me show you kind of a investing for retirement portfolio that I use this as an example. Okay. And the reason I use this as an example is because this is basically how I invest for retirement. So I'm 36 years old, and I want to show you what I do. And I've got a little difference here, but this is, for the most part, this is what I do. And again, everybody's different. So don't come down on me and say you're wrong. I'm not wrong. I'm just doing it the way I do it. Right. My favorite color is blue. Yours might be red. You might be green. Okay. I'm blue. I'm from Kentucky. Go Wildcats. Okay. Blue is my favorite color. But this is how I invest, and this is what I tell people. So Vanguard S&P 500 ETF, VOO, that's my main holding. So let's say that's 75% of my retirement account holdings. So the majority of my retirement contributions are going into the Vanguard S&P 500 ETF or some form of the S&P 500 or total market. So that could be VTI, which is your Vanguard Total Stock Market Index. That could be RSP, which is the Invesco Equal Weighted S&P 500 ETF. The reason I like having a combination of all three is because you have differences in the indexes. So the Vanguard S&P 500 ETF is based on market cap, whereas the RSP, which is the Invesco, okay, S&P 500 equal weight, it takes the 500 stocks in the S&P 500, gives them an equal weighting, which means that one stock doesn't affect the entire S&P 500 index. Yesterday, Disney was up like 6% because they fired Bob Chapek. They fired him and they brought back Bob Iger. The Dow was up because Disney really moved the index. So the S&P 500 ETF is market cap weighted, so you can see that a little bit. So 75% of my retirement contribution is going into some sort of market index, aggressive growth. Now, about 10%, now this is recent, 10% is going into some sort of fixed income. Now, TLT, the iShare 20-year Treasury bond is on there. I've also got different things like short-term treasuries, tips, things like that. With interest rates going up, now this has not been a long-term holding, so we're not talking about 3, 4, 5 years. We're talking short, just recent. With interest rates going up on the treasuries, it makes sense to add a little bit of fixed income into your portfolio to get that interest, right? Especially if you are in the camp, and I'm not telling you this is what's going to happen, but if you believe the Fed is going to slow down, stop, or pivot interest rates, it's good to have a little bit of fixed income in your portfolio. Now, as you get closer to 50, 55, 60, that's something that you really want to have a conversation with an investment advisor or a financial advisor about, especially if you're moving from capital growth. So I'm going, like mine is capital growth is my main goal. Grow. But eventually, like my dad's 69, he still works. He's been a financial advisor for 50 years. But he's going from more growth to preservation, right? He's 69, my mom's 67. They want to preserve their money. So they're not going to have their retirement contributions or their investments going into the S&P 500 as much as they are into other conservative assets. Might be dividend stocks, might be preferreds, might be notes, might be something. Who knows? We just have to look at that. The other thing I encourage people to do, especially if you're investing on your own, own a little stock. Own some stock. Now, most people say, I don't understand stock. I don't want to buy any stock. It's too confusing. You lose a lot of money. Well, here's what I tell people. It's the old Jack Bogle, right? Sitting on my desk is a book called The Intelligent Investor by Benjamin Graham. You can pick that up at your local library, on Audible, on Amazon, whatever. But just here's what I tell people. I want you to invest the majority of your assets in the S&P 500 into some fixed income, ETFs, passively indexed ETFs. But then also buy a little stock. If you have a brokerage account, if you have an IRA, if you have the ability to do that, some 401ks have the ability to invest in individual stocks. But here's the stocks I want you to buy. Where do you shop? Where do you buy pizza? What do you enjoy? What are some of your hobbies? What do you like to do? Because don't listen to somebody on YouTube who's telling you to buy this crypto that's going to go through the moon. Right. We saw what happens when you listen to people on YouTube about cryptocurrency, right? Don't listen to people who are telling you to buy this next stock because it's going to take off. No. Where do you go? Well, I go to Walmart a lot. I got 3 kids. We have Walmart Plus. I get it delivered to my house because I don't want to go to the store because I got 3 kids. Have you gone through a store with 3 kids lately? I have. I went to Target the other day and I wanted to boom with 3 kids. My kids are wonderful. I love my kids. I would do anything for them. But man, it's hard going to stores, but I go to Walmart. So we own a little Walmart stock. Apple. I'm a big Apple guy. I got a Mac. That's what I'm talking to you on right now. I've got an Apple phone. I've got an iPad. I've got Apple everything. And the infrastructure at Apple to me is really good. So I own a little Apple stock. Caterpillar. I believe, I've got some family members with Caterpillar. So I own a little Caterpillar stock. Buy what you know. Buy what you do. You like Nike, you're into kicks, you like shoes, buy some Nike stock. Here's the trick though. You never want to have a single stock be more than 10% of your overall retirement savings. So if you have $100,000 in retirement savings, never have more than $10,000 in that single stock. You don't want to affect it too much. I would say you don't want more than 5% of a single stock to be more than your retirement savings as total, because you don't want that single stock to affect your overall retirement plan. Now, look, because Walmart's done really well the last few weeks, they had really good earnings, even though Target stunk. Apple's not had so much good. Caterpillar's been really good lately. So you don't want these things to affect these things, because this is where we're really trying to grow. And if you look at it, total return, investing for retirement, 15.27 year to date. That's what we're negative, obviously, October 2022. I'm sorry, it's October 2022. November 22nd of 2022, S&P 500 is down 15.92. And on a 1-year scale, we're down 13%. The S&P is down 14%. Now, again, we're not trying to beat the market there. I'm just trying to show you how, as a 36-year-old, we're really investing for retirement. Okay. Now, John says this. We asked for some advice. John says, I'm 50% U.S. large cap, 25% small caps, 20 in U.S. stocks, and 25% international. John's good. That's a good mix. That's a really, really good mix. Alexander said this, had 0 401k in 2001, started putting 25% biweekly and 10% invested biweekly for my wife, sitting on 1.1 million. Currently, you can do it. Yeah, you can. Compound interest is the greatest driver of compound interest. I always say this is God's greatest gift since Jesus. Compound interest. Everything you do in life is compound interest, but your money compound interest is awesome. I think is your thing mucus of Wonder Home. I think that's what it says. I have experience of half my money being in target date fund for 15 years. Trust me, it's not a great idea. Mucus, thank you so much. Can I call you Mucus? Is that okay? Do you have a name? Maybe I won't call you. Like, here's Kevin. I actually asked his name. Like and subscribe. Help Drew buy compound interest faster than the S&P 500. Yes, like and subscribe if you haven't done so already. So how do you continue to grow your 401k and your IRA? Continue to contribute. Continue to invest. Invest based on your age and your risk tolerance, and stay away from things that you don't understand. And if you have the ability to invest just directly into the markets, maybe not using target date funds, but investing directly in the markets, to do that. If you want help with that, contact me. I don't want to be selfish because there's a lot of great advisors out there. But if you want help with that, whether you live in California, Maine, Florida, Kentucky, my favorite state outside of Florida, Kentucky, go Wildcats. Give me a call. All my information is in the description below. We are registered in the United States, so we can help in any team or any state. You got me thinking basketball. The Cats play tomorrow at 4 o'clock. Had a couple rough games, lost to Gonzaga pretty handily in Spokane, and lost to Michigan State. Michigan State's good. I think people don't think they're very good. They're good. They're really good now. All right. So let's go through this real quick. Let's recap. Average retirement savings. Let's start with Vanguard first. Average retirement savings with Vanguard, 25 to 34, 37,000 is the average, 14,000 is the median. 35 to 44, 97,000 is the average, 36,000 is the median, save for retirement. This is where I live right here, 45 to 64, $179,000 is the average. We don't care about averages, we care about medians. 61,530 and 89,000, 89, come on, give me that middle number. Okay, 89,716. Those are the amounts that are saved for retirement amongst most Americans in their 401ks or IRAs. We need to do a better job of increasing that. If you're on the live stream, just joining us, make sure you go back about 5 to 10 minutes and let's look at ways that you can contribute and invest more for retirement. And if you're investing for retirement now and you've done a good job, leave it in the comment section. Let me know what you're doing. I do try to respond to every comment out there. Unless you say something mean or nasty, then I won't comment back. But if you don't, I will love to talk to you about what you're doing and here, because we want to help others. We're a community here at Your Financial EKG, helping everyone save for retirement. We want to get you to retirement, want to get you through retirement, and want to protect your ability to stay in retirement. All right, I got about 10 minutes. Let's look at Fidelity real quick. So Fidelity, where are we at here? Fidelity savings. Here we go. Average saved at Fidelity. We just looked at Vanguard. Let's look at Fidelity now. Average saved with Fidelity. IRA, 101,900. That's the average. They don't give the medians. 401k, 97,200. And 403b, 87,400. So still too low. We need to increase these. And I saw this the other day, and I thought I would share this with you guys. Let's see. Does this show it? Yeah, here we go. This is a Wall Street Journal article that was just out yesterday. Was this yesterday? It's either yesterday or the day before. Here we go. As savings slowly shrink, consumer spending is on borrowed time. Here's what we're seeing. Spending remains strong among consumers, but they're using up their cash, okay, that they gained during the pandemic to do that. And if you look, there's a really interesting chart here. Here's the stock of excess savings. So here's where we were 2020. Got those stimulus payments, stimuluses, and look at it. It's starting to go back down. So people aren't saving as much as they used to pre-pandemic. And I know we're going into Christmas and people like to buy gifts for kids and all that, but my encouragement, do not go into a debt for Christmas. Don't go in debt buying Christmas, because your kids, your family members will be better off if you're able to show them financial stewardship instead of paying off Christmas gifts in January, February, March, April, May. Here's the rate of personal savings as a percentage of disposable income. Look at this, 2020, 2021, stimulus. And look where we're at now. We're back to that 2015 levels. So make sure you continue to invest and continue to contribute. This is a Wall Street Journal article. You can check it out. As savings slowly shrink, consumer spending is on borrowed time. What this tells me as a financial advisor, this is talking about consumer spending and consumer savings, which means people aren't investing in retirement as much either, because now they're lacking. Think about it. If you're mentally, think about it. If money's coming out of your savings and that's going down, mentally, you're not going to look at that and go, oh, I can save more for retirement. My savings are going down. No, you're thinking, oh my gosh, I got to pull back somewhere. I got to stop investing in my 401k. I can't make that IRA contribution because I can't make it because I save it. You cannot afford not to make that 401k and IRA contribution, especially if you are younger. So make sure that you continue to invest in your 401ks, in your IRAs, so that you can get to retirement, through retirement, protect your ability to stay in retirement. I'm going to stay on here for a few more minutes. If anybody has any questions, let me look at the comments here. See if we've got, okay, first shot. I'm 43 and 100% stocks in my investments. Got to get that growth. I hope to retire at 55. Got a lot of can I retires at 55 first shot. Make sure you check those out. 43, 100% stocks. That's great. Obviously do what you got to do. But I think if you have the ability to invest now for growth, you're in your early 40s, late 30s, man, have all that investments go into stocks as much as you possibly can. And like I said, I've got a little fixed income in there because interest rates have gone up, and it makes a little sense to get some of that interest rates there. All right. Okay, guys. Hey, no more questions. Thank you so much for coming to the live stream. I love doing this. We did this a little earlier in the week. Normally we do these on Thursdays, but we did it on Tuesday this week because Thanksgiving's on Thursday at the recording of this video. So I hope you have a happy Thanksgiving. Thank you so much for watching. God bless. Bye-bye.